All right, I would like to introduce Sue Porter, partner with KPMG here in Kamloops, who's going to speak to Grow Your Biz Kamloops board about the implications of incorporation on taxation. Take it away, Sue.
So I've got a printout coming out here because, like I said, I'm going to talk about proprietorship and incorporation, and a lot of the stuff that I'm going to talk about regarding proprietorship, so if you're unincorporated, a lot of it's still going to apply if you're a corporation as well, but we'll go through some of the high level what's the difference. So the form that we just handed around is called a T2125, and what that form is, what that form is actually what you actually have as a business schedule if you're not incorporated, okay? So one of the first questions I always get from people, whether they're incorporated or they're not, is what can I write off as a business expense? Because everybody thinks that if you're not an employee, I can write everything off. And it really comes down to if you've incurred something that's actually going to assist you in actually generating business income, and you can come up with that argument without laughing at yourself, it's probably a business expense, okay? So making a mortgage payment or paying for your kids' daycare, not going to work. But if you've actually got a cell phone and that's how your clients phone you or your employees phone you, probably can make it a business deduction, okay? So things like that. So when you look at the 2125, it does have different categories in it. And I don't want to go through them extensively, but I just wanted you to know what's physically there. I don't know if any of you sell stuff online. Does anybody here sell things online?
Sometimes.
And the only reason I'm saying that is just add a tidbit of information. Whether you're incorporated or not anymore, you're going to notice that your accountant's going to start to ask you information about what your website is and how much you sell online, because you're required to disclose it to the government now. They're actually trying to figure out if there's an underground economy. So there's going to be a bunch more disclosure around selling things online. Okay. So there's two types of business expenditures, again, whether you're incorporated or not. One's going to be an operating expenditure and one's going to be a capital expenditure. So an operating expenditure to me is anything that's, I'm going to say, consumed in a year: paper clips, rent, things like that. Capital expenditures are things that actually have a life that's longer than a year. So you go and buy a computer, or you buy the board and table, or you buy a chair. Those are capital expenditures. Capital expenditures are treated a little bit differently. They actually are written off over time, and there's actual asset classes that are set by Revenue Canada, okay? I've also got some notes regarding restricted assets, and one of them particularly is when you have an actual vehicle that's owned by your business. So Rob, in that book that I've actually physically given you guys, I'm not going to ask you to read the whole book, but that's a book that we publish every year, and it's got particular chapters that go through really specific things. It talks about RESPs, it talks about RRSPs, it talks about if you're self-employed, if you're employed, all those kinds of things, so you can cherry pick what you want to read. And one of them that's in there that's probably a good one to read, especially if you're incorporated, is about an automobile. Because it really comes down to how much you use it for business. So if your business physically owns an asset, the thing to keep in mind is when you actually are incorporated, your corporation is a totally separate legal entity from you. So if it goes out and buys a $50,000 truck and you don't use it for business at all, there's something called a standby charge, which is a taxable benefit that would be put on your personal return because you're using a corporate asset. The other one that I've had quite often is people think, oh, my corporation's got a whole bunch of money. Let's go buy a condo at Sun Peaks. Well, guess what? You're using a corporate asset, so you have to pay fair market value to use that asset. So it's not always the most appropriate thing to do. Okay, so the total aside on restricted assets. So does everybody know, or anybody want to say how long you have to keep records for, whether you're incorporated or not? Anybody know the answer? 7? Right?
7.
Yeah, so what I normally encourage people to do is, if you're bringing stuff to an accountant and it's all going in a box or in an envelope, when they give you that envelope back, write the date on the outside, because that way you know when you can take it to the shredder, right? Otherwise there's quite a lot of information that people end up with, and so just to make kind of streamline your life a little bit.
So when you get audited, they don't go back further than that?
No, usually when you're going to get audited, they're going to go back 1 year first. Then they'll go, if depending on what they find, if they find something stinky, probably 2 to 3, but they're not going to go back further than 7. Yeah. And you can apply to Revenue Canada to destroy records earlier. I haven't ever seen anyone do it because I always worry that if you actually ask, yeah, guess who's coming to visit me today? Yeah. And actually, that's a good question. So one of the things that I will say is, our observation in the last 2 years is that there is tons of auditors out there right now. So if when I say this, you're just going to laugh, but as far as I'm concerned, the provincial and the federal government are broke, and so they are sending out auditors in droves. They're actually trying to enforce some stuff that's not even rules, or they're saying that, oh, well, you did this wrong, when the Income Tax Act says something totally different. And the hard thing is there's an actual audit division and there's an appeal division. They're totally two separate things. So the audit division's going out in droves. They've hired probably double the amount of auditors that I've ever seen. And if you want to appeal, in other words, say, I don't agree with this ruling, you actually go over to this department and they're 3 years behind. So they're hoping that you'll just give up and just pay, kind of idea. So just be really careful. So if there's ever a time to be conservative, it might be 2014. Okay.
So what happens in that situation if you're audited and you want to appeal it?
Yeah.
You make your appeal.
It's called an objection, and it's a formal document that you do.
Do you still have to pay whatever?
You actually can not pay, but you know that there's an interest that's accruing on it, and the interest is 2% more than the traditional bank. And the fact is, it just starts to compound. And so the fact is, like I said, if it took you 3 years, and let's just say you even were lucky and only had to pay half, the fact is you would have to pay half plus the interest on that half. Yeah. So that's the hard part about it, right? And they're quite strict right now. So I wouldn't do anything that's kind of in the gray area at this point in time, and that's what we're telling all of our clients.
So going back to the years to keep the record, was it ever 6?
I don't know if it was.
No?
No.
It's always been 7.
I mean,
That's your-
I'm probably thinking when you get into year 7, you can start to destroy it. Maybe that's what I'm thinking.
Okay.
Just know that it's not a year or 2, because I had some people go, oh yeah, I just cleaned out my house, and I kind of went, what do you mean? You've only been in business for 2 years, right?
I thought they just changed it to 6.
So did I.
Oh, and maybe
Because
I was-
In the banking world, it's always been 7.
7?
Yeah.
Yeah,
Okay.
because I was keeping for 7, and then I thought I heard somewhere they
And
changed
maybe,
it to 6.
you know what?
Yeah.
If anything's going to tell you, it's going to be that book.
Yeah.
Okay.
And so they do want everything, source documents, electronic records, all that kind of stuff that you should keep. So when we talk about vehicles, I don't know if any of you want these. This is the old school, these little logs. So what Revenue Canada used to do is they used to say, okay, if you're going to use your vehicle, whether personal or business, for business at all, they want you to keep a log. And it used to be for a 12-month period. Nobody did it because nobody wanted to keep a log for 12 months. So they've lessened those rules, and they've said if you actually have a pretty static business, and it's static business use, in other words, not a seasonal business, you can keep a log for 3 months and extrapolate that for the year. So when I say this is old school, you can use this still, but my comment would be most of you carry a smartphone, and there is apps out there, because your phone's a GPS. And so it's got a little app that you can download, probably cost you $2 or $3. You get in your car, you press start. When you get to where you're going, you press stop, and then you put what the business trip was for. It's interesting because I've got clients that actually just send me printouts during tax season going, here. And I've got a beautiful Excel sheet telling me, here's the business trip, here's how far it was, and here's what my business trip was for.
Wow.
That's
Okay.
a clever app.
It is
So
very,
there.
someone was quite smart. So, like I said, I brought these, if you'd like one, that's fine, but like, this is old school. And I just say to people, keep it in your glove box kind of idea, but the app works very well.
Kevin thanks you.
Okay, perfect. He owes me something. The other one is use of home as office. So and I don't want to get into technical rules, I'm just here for interpretation, but if you actually see clients in your home and that's your main spot of doing business, you can actually, and that office space is used for office use only, in other words, you don't have kids sleeping in there kind of idea. The square footage of that room as compared to the whole square footage of your house, you can actually write off mortgage interest, property taxes, power, like all those kinds of things. So whatever that percentage is for the year. Okay, but just gotta have some stipulation there. If you have a storefront and you have an office in there, you probably can't use your one at home. Like in my KPMG circumstance, I can't, right? My storefront's where I see people, it's where my computer is, so.
So how,
Go ahead, Charlie.
well, I write off my home office
Yeah.
and all the percentage of expense,
Yeah.
relevant expenses, but we have a few computers and people hop on my computer because it's got a bigger screen and use it, and I've got two offices in my house,
Okay.
one with a view and one without.
Yeah.
And so I think, if people are, it's one office is in quite a, a common area, would that still be,
Are you saying that both rooms in your house are you saying, are you
yeah, I
asking-
kind of have a quiet room, and then I have one that's sort of more, so it would be legit to kind of write off that
I would
space.
think so, yeah.
Okay.
And so if you've paid your mortgage off, I guess, you
No, you can't charge rent.
can't charge rent?
No, that's a really good question, though.
But isn't there some implication now if you're writing off your mortgage, where there's some, I don't know I heard something about that, it's probably in that book, where if you went to sell your house, you have to declare capital gains
No.
or something like that?
No, what they're trying to physically get at usually, and that's totally, if someone has a suite in their house.
Oh, okay.
So usually people will say to me, so I just did, renovation to my house and put a suite in my basement, and I spent 50 grand. I want to write the 50 grand off. And I'm like, well, what did you do? And usually it's, okay, well, I put up some walls and I put in a bathroom, and that's where the big expenditure was. You can't write that off because it just improved the value of your home. And if you want to use your principal residence exemption, you shouldn't be writing that off, kind of
Oh,
idea.
okay.
Get my point?
Okay, yeah.
So you really want the whole thing to be tax-free,
Right.
kind of idea. Okay? But when you get to mortgage interest, you can actually write that off against rental.
Okay.
So totally that's
Oh,
fine.
okay.
So the other one that I wanted to pass around, I'm going to let you pass that one around. So I just wanted to quickly go over what is the difference between being a proprietorship, so unincorporated, and being a corporation. And then I'll go into, I've got a quick slideshow regarding incorporation. And then if you guys want me to, I don't need to. I've got some information here about GST. I don't know if anybody's going to find that applicable. I've got some information about PST, and I can just give you the handouts. I don't profess to be a GST or PST specialist. The nice thing about being part of a large organization is I have people that just do that. So you can see where I got this from. So I got this out of the BC Registry, just talking about what the difference is. And so when we talk about a proprietorship, obviously, if you make $100,000, even if you only spend $20,000 of it, you're going to be taxed on $100,000. That's what happens in a proprietorship. And you're taxed at gradual rates, personal rates, and our personal rates can get quite high now. If you make more than $150,000 a year, it's almost 47%. Whereas when you actually are a corporation, I'm not going to talk about partnerships, but if you're a corporation in the province of British Columbia, on your first $500,000, you pay tax at 13.5%. Pretty sweet. Now, the one thing to keep in mind, and I don't know, like I said, I'm just here to interpret information. If you've got multiple corporations and they're owned or they're related, is what we call them, they do share that $500,000. So in other words, you have a $500,000 small business limit. If you have two corporations that are owned, let's say, by the same person or same group of people, they share that $500,000. So in other words, if you made more than $500,000 between the two, somebody's paying tax at a higher rate, which is 26%. Okay?
Sadly, I don't have to worry about that.
Yet.
Yes, yeah.
Yet.
Yes, I'd say, just say yes. So it talks about, one of the things that people really talk about a lot is, I want to go incorporate my business because I want to avoid being sued. And usually that is the biggest thing about going incorporating a business. If someone has a risky business where insurance is not going to cover them off, we encourage them actually to go incorporate.
Some businesses don't really help you. Like if you're a lawyer, you'd
No.
be sued personally. in
Lawyer,
your
a
capacity as
doctor,
lawyer, yeah.
dentist, same thing. So there's certain professions that you can't get around if there's personal liability. But if you're Joe contractor, you could try to avoid something that way, okay?
Because my former doctor
Was incorporated? Yep, and there's a reason they incorporate, mainly to have the small business rates and for the deferral, which we'll physically get into, but it's not to avoid liability.
Okay.
Yeah. So The difference, obviously, between a proprietorship and a corporation is that it is a separate legal entity from you. It does have a 9-digit business number that's the same as someone's social insurance number, so it totally stands on its own. And so when you talk about who owns the assets of the business, and this is sometimes hard for people to wrap their brain around. I have people say to me, well, I'm a shareholder of my corporation. Why isn't that truck mine? Well, it's not, because your corporation's dollars were there to buy it, kind of idea. So that's the difference. When you're a proprietorship, you own everything. When you're a corporation, your corporation owns the assets that it buys. And so when we talk about income in a proprietorship is all taxed on a personal tax return.